Hey Trade Pros, it's Victoria from Trade Pro Academy, and today we've got a very special video for you as we have recently just jumped into a quite interesting predicament here in North America. As you can see, I am recording from my room. We are currently in quarantine mode, and it's not just North America, it's the rest of the world as well. So in today's video, we are going to talk about the effects of the Fed, as you can see on my screen, on this most recent coronavirus update. So we're going to be talking all things Corona, investments, and how you guys could potentially take advantage of this and how this represents a very dire situation, but also an opportunity. So before we get started, guys, smash that like button if you guys are watching this from home in your quarantined areas. Hopefully you got some toilet paper on stack because people have been going a little crazy. And hit that subscribe button because we're going to have more videos about this stuff coming out, and also drop a comment down below what you guys want to see in the coming videos. So without further ado, let's go ahead and get started. In today's video, we're going to cover a multitude of topics. We're going to look at a lot of charts. I'm going to look at the Fed funds chart right here, Fed funds rate. We're also going to look at the S&P 500, potential investing opportunities in equities, the VIX, bonds, gold, and bond yields. So a lot to go through, and we're also going to be talking about what really happened here and what we could expect from the Federal Reserve, how they may act considering they've dropped rates significantly. So let's just go ahead and get started. What has happened so far? What has the Fed done so far? So far, March 15th, we saw an exponential drop in rates here. This is the Fed funds rate chart, a historical graph of what has happened. And we have dropped off right here, as you guys can see, a very vertical line back down to zero levels that we have not seen since about right here around 2016. They started climbing 2015, sorry. But before that, we saw the drop happen at around that 2008 level. And guess what happened after that, right? We had that financial crisis. Now, what has the Fed done on March 15th? They cut rates down to zero from 1.25% in another emergency cut. So far in March, we've had two emergency cuts. The first 0.5% or 50 basis points, and the second pretty significant here all the way down to zero. So the Fed in this year alone has cut rates down to zero, a very drastic measure in combating what has been going on in terms of this financial crisis in 2020 that has been started off or catalyzed, if you will, by this coronavirus outbreak that we will talk about very shortly. But for now, what has the Fed been doing? I'm sure that everyone's aware. You can see they drop rates back down to zero. And what this usually means, a 75 basis point cut in a single year usually is recession protection, let alone a 1.75 basis point cut in just a matter of weeks. So what does this mean? This means that they are preparing for the worst, it seems, as markets have dropped about 30% from all-time highs, which isn't the worst thing to happen because all that does is eliminate all the gains from last year. So it's very important to understand. Of course, a very drastic drop in just a matter of weeks. There's no doubt about it. But we have come back so far only to wipe out last year's gains. We'll look at that chart soon. But what has happened in historical times when you see a strong Fed rate cut to such magnitude? Yes, in 2000, we saw that dot-com bubble crash, but also we didn't really get down to zero. We got a significant drop from about 7% all the way down to 1.5%, which is very, very significant. We saw that crash happen again in 2008. We saw it from those fives or so down to zero again. And that was protection to help out financial assets from just rocketing to the downside throughout that financial crisis in 2008, 2009. So what else has the Fed done other than cut these rates? I'm going to explain to you why you should consider this rate cut maybe as not the best case scenario here, but the Fed has also tried to inject about $1.5 trillion in repo rates. Of course, these are offers to buy these treasuries, but not all have been actually received well. I think it was last night or so. I'm filming this on St. Patrick's Day, Tuesday, when all the bars are closed. So I believe last night they tried to offer $500 billion again, and only about 100 billion were accepted from that offer. So they can offer as much money as they will, but will they accept these offerings? That is the biggest question right now. So they also injected $700 billion of QE5 because QE4, remember, started from the repo rate injection. So let's call it QE5 for argument's sake. They also injected $700 billion in QE5 to combat this. So we're nearing the $2 trillion mark, or just above, actually, just above, just around $2.5 trillion mark of just injecting or trying to inject cash, not quite doing it successfully, and also a cut to 0% in the interest rate, in the Fed fund interest rate. So the Fed is just going full steam ahead with this and trying to revive this tattered economy, and also this what we've seen in a quarantine crisis here. Now, another consideration that the Fed has had in recent days and recent weeks is actually starting to purchase assets on its balance sheet. And by assets, they mean several stocks. So the stock purchasing process that they are considering will again artificially inflate these stock prices we've seen before and give them a skewed value. So that's another thing that they're doing to actually, or that they're thinking of doing, sorry, I should say, thinking of doing to actually get this thing back afloat rather than just seeing it rocket to the downside. But one thing that they should consider in all of these scenarios is that we do have the 0% interest rate, correct? Like you can see on the chart here, clear as day, before we look at other charts. We do have that 0% interest rate, and what that does is propel people or give people interest to buy in the stock market, buy equities, and put that really cheap cash to borrow in a place where they can exceed that yield. So if they're borrowing for, let's say, I don't know, 0.5%, 75 basis points, these are just random numbers, doesn't mean you can borrow for that little, but let's say they're borrowing for 0.5%, they're going to somewhere that yields them at least over that, right? They take this very cheap money and they put it into a market or an asset that will yield more, so it makes the cheap borrowing worth it, right? Well, if the stock market is plummeting, then they can't put that money anywhere. So the 0% interest rate won't really help, because not many institutional buyers are actually looking to borrow very cheap money to put into this nosediving market. So even with that, they'll need something more, right? They're injecting all this money, no one wants to bid in their offers, and now the institutional money is not taking in this 0% interest rate to their advantage to buy this nosediving stock market, which makes sense. Why would you want to buy the falling knife? What they do is wait until it starts to bottom out and show signs of strength, signs of recovery in the economy, and then they start putting money towards that and borrowing at the super low interest rate. But that is currently not the case. Also, something to note is the coronavirus naturally. Well, the coronavirus effects have not yet been reflected in what we've seen in value in companies and different companies, right? So the coronavirus actually has closed down borders in the States and Canada. Some supply chains have been cut off. We saw that in China earlier on. We haven't seen the real effect on business earnings and the bottom line as of yet. So in the next few quarters, next few months, we're actually going to see that trickle down effect. You'll see unemployment change, housing starts, all this, and it'll come into a more lagging indicator rather than showing us right away how these do affect businesses. You can see a lot of people have been quarantined at home. A lot of people aren't earning salary. Fiscal stimulus from Trump actually includes a deferral from the IRS of taxation on people's actual income for the next 2 weeks. So we'll see how this affects the actual value of things, companies, whatever it may be, in the next few weeks. So that's something very interesting to note and watch out for. So we haven't really seen a bottom yet, if you will. We haven't seen the real numbers, and for that to happen, we have to wait a few more weeks. So when do you start investing? Is this an amazing opportunity? Things dropped about 30% already. Why haven't you started buying? Well, there's a few things to consider, right? You could start buying incrementally as it drops. You'll never catch the bottom realistically, but you can start buying incrementally as it drops, looking for investments. But one thing to consider is, out of the S&P 500, will it remain the S&P 500? How many companies may go bankrupt from this? I'm not saying they will. That's a very, very worst case scenario, but how many will stick around? So we have to look at both the VIX and the S&P 500 chart right now. So a bottom out based on a technical is very difficult to kind of judge here, but you can see it's made a very drastic plummet to the downside. And where can you find value in different stocks? Well, one thing is see if the S&P 500 remains the S&P 500 and just start buying ETFs on the SPY, which is an option. But let's take a look at what this chart really looks like first. So as we can see, trying to find the bottom on a technical aspect is a little more difficult, but what we can do is look at some levels here and see what a potential scenario would look like, a good case scenario based on the S&P 500. Now, last time around when we saw something, not of this magnitude naturally, but last in 2018, around September, we saw somewhat of a drop here from all-time highs. If we grab this high down to the low, we dropped about 21% from that high down to the low before we actually saw the Fed and the government start intervening with the PPT, Pledge Protection Team, and just starting to buy assets and starting to flood money back into the market. Now, this was not a coronavirus situation where a lot of businesses were shut down and the supply chain was kind of dismantled, but in this case, we just saw overvaluation of the market, and We saw quantitative tightening kind of lead up to this, then quantitative easing had to come back in and kind of save this thing. Now, the Powell put was suggested to be at 23.50 last time around, and very interestingly enough, you can see this is where price is beginning to stall this time around, 23.50 down to the tick. We drop down to that level and we see a slight rebound. Now, if we go into what happened in 2008, 2009, of course, completely different story, right? You can see that from this drop, it didn't happen at quite such a velocity because it took time for the information to actually come into the public and the market. And of course, it was based on mortgage-backed securities rather than a global virus pandemic. So you can see what happened. We dropped, rotated slightly, dropped, rotated slightly, dropped. There wasn't a knife down as we have seen in this most recent case. And to add to that here, what we could see is actually a temporary bottom here and stall out around these 23.50s. If we do manage to close this week, we won't know because it's Tuesday, right? If we manage to close this week above that level, I think we do see a slight pullback into some of these levels of 50%, maybe somewhere in these 28.80s. But again, what do fibs mean? We're just going to be going by pure technicals here, see what the volume is like and everything. So we have a potential stall into the 2900s. I really don't see it climbing that high unless we get some good news out of the cases starting to subdue in terms of coronavirus, and we actually start to see some businesses and supply chains being open. However, a lot of places are actually shutting down until April, so that gives you 2 weeks of potential just crazy uncertainty. So right now, the first area of resistance is going to be 2700, and then ultimately above 2900, we actually do start to flip the script. But above the 2700, you have to start understanding that, okay, there might be some strength in this, there might be some reversal to this, and at this point, it might not be the worst thing to actually start looking for some upside. But as long as we maintain below 2500 and 2600 on the continuous futures contract of the S&P, and if we do manage to break below the 2350, then it gets a little scarier. Those are the two areas to watch for. Between 2350 and 2700, I think are going to be very, very key levels for us to look for initial movements. Now, if we grab the top, the all-time high of this market down to the bottom of this move, we're down just under 31%, which of course comes down into pretty much erasing only the gains of 2019. Again, that's a lot, considering where we've gone, could just erase a whole year's gain. But if we look for on a more longer term scale, you can see where some resistance starts lying, support structure starts lying. And this was actually today's 7% halt area where it gets really, really interesting. And that is the low 2100s to about 2000s. So this is where price starts to potentially bottom out in terms of pure technicals. And I think there's going to be a little more PPT action around some of these key areas as there were last time based on some of this market structure movement. So if we crack these lows under 2315, it gets really scary down into these 2100s, 2200s. That's kind of a target level before we start to see a little more extreme action from the Fed, PPT, and just fiscal policy, monetary policy, and all of that. I think that becomes a super, super strong area of worry if this isn't already. And where does that lead us to? The 2000 level is a 41% drop from all-time highs, 2100 38%, and 2200 about 35%. So at 35%, the 2200 level isn't that far away, and we could see something into that area should we not rebound a little this week. So we have to really watch how this week closes. We managed to close on a green week for the first time in a long time, then we could see a potential rebound and maybe some market buying. But again, 2700 is the area to watch that we have to break above and close above for the week. That's going to be a pivotal area. And if we manage to drop through that 2350, then it gets a little more dangerous to the downside. So when is it time to start buying? Well, first things first, we need the VIX to settle down, right? The VIX is reached today, on Tuesday, it reached 84.83. The all-time high is about 96.40 based on the 2008 pop in October 2008. So we are nowhere near subdued volatility and uncertainty in terms of what this fear index is telling us. So for that to happen, we need to just drop back down well under the 50 level and even the 40 level to actually start increasing some of the certainty and decreasing some of the fear. Now, as long as this thing continues higher, then I don't think this downside is over, and we don't think that the risk is subdued at this point. How do you know when you could start investing in this market? Well, you need to see strength, maybe days of strength, weeks of strength, and a potential of good news out of the coronavirus cases in Italy, Spain, just the whole world. As long as there are cases that increase throughout the world, especially in Italy and Spain, which have seen an exponential increase, that means that we could see exponential increases in the States. Once they start actually reporting real figures and getting everyone tested, then we'll know what the truth is. Until then, all we can do is wait and see how this fear just drives into the market. Until businesses are closed, we won't see a potential rally in this. We need to see what earnings are doing, and we could even see weeks of potential more downside. Maybe not as quick in velocity, but it's very, very uncertain still. So when the certainty starts to come out and we start breaking above levels and holding them as support, holding levels as strong, just sideways movement without sharp spikes to the downside on volume, then we could start looking for potential longs. Yeah, you could layer in on the knife lower, right? But at a certain point, you might have to call it quits. And what happens? How did the sell-off happen? Just panic selling. Panic selling happened, and that's what could happen below this 2350 level again. And then through another level, 2200 again. So you want to see it start bottoming out and showing some signs of strength, higher highs, higher lows on a 4 hour, 1 hour, whatever it may be. But the main thing is you have to keep an eye on what the world events are to see a potential bottom. The VIX is a good indicator. Fear starts dropping, maybe a potential rounding out. When could we see this? Maybe April, maybe May, maybe June, but probably not in the next month. Now, bonds are typically supposed to be a risk off asset and see an increase on both rate cuts and just general fear. So we've seen both of these, and we've seen the bond market rally just a bit. You can see the T-bond futures on the ZB right here, pretty strong pop. We've started pretty well from the late February levels, kind of where the drop started to happen on the S&P. We've rallied 20% to the top here, and then we've kind of seen some subdued downside, right? We need to see bonds start popping because yields are just nose diving. And if bonds don't start popping, then there's no real yield anywhere, neither in the equity market, neither in the safe havens. So that's an area that we really, really need to watch. We need to see these 30-year bonds continue to push higher, these T-bonds, right? They can't really turn back, especially coming back into these previous peaks, July 2016. If we pop through that area, it gets really, really dangerous at that point, right? You can see the pop on the bonds in 2008, 2009. Crazy pop, right? Through the previous highs, no problem. We need to see that kind of rally continue. There is yield to be had, and if there's more downside. However, if bonds start trickling off, that is another earlier sign that potentially we could see a slight bottom out in this market. You can see we stopped really diving. We stopped really nosediving on the equity market as soon as bonds started to pull back a little, right? We expected a pop from the rate cut, but you can see it's pulling back slightly. There's really no yield that's available here in any of these markets. And as you can see on gold, now gold, another safe haven asset, we see it drop drastically from that 1700 area here that we've seen very recently, these new highs, new decade, 15-year highs, whatever it is. And we've seen a pretty significant drop through that 1500 over the last few days at the end of the week. What happened? How did this start? This is just panic selling. This is profit taking. It's people selling out of the market and getting into cash. Cash is king at this point to look for markets that have a high yield return, and potential for an increase in valuation, right? And right now, we need to see gold start popping as well. Should the equity market drop, should gold continue to drop, then we could see a subdued measure. If everything just collapses at the same time, then there's no yield anywhere, no value anywhere, and we just have to stay in cash. And that is what propels a lot more of this panic selling into cash and waiting it out, see what happens. This huge global fear of the coronavirus is putting everyone back in cash. So gold bottomed out around these 1450s, I believe, and then we had a slight pop. We're back above the 1500 level, which is good. For the safe havens, if you guys are looking to put money somewhere, this could be a potential pop back to even the 2000 level. A lot of analysts agreed on. So if, again, uncertainty and fear continues to nosedive, some people are going to have to start putting money somewhere at a certain point. Otherwise, there's going to be a huge cash on hand, and none of these assets will ever really do anything without the intervention of government or political figures or the Fed, whatever it may be. So gold, again, could be en route. If we manage to climb back above that 1600 level, we could be in for a new high, and we could see more money flood into it as the equity market drops. The same with bonds. Now, the last chart I really want to look at here, again, none of this is investment advice. A little disclaimer there. This is all just based on analysis and what's going on and what we see it as. We see the bond yields coming back and converging with the direction of the S&P 500, which is what we wanted to see. So bond yields diverged quite a bit, and we speculated that there would be some kind of convergence in either bond yields rising up, or the equity market dropping down. or we get the convergence and they both just start moving in the same direction. So that's what we saw here. Bond yields drop, and you can see rate cut kind of affects the short end yield of the curve. And we saw a pretty significant dive in the bonds. You can see they're popping up here a little. Bond yields are popping up here a little while the S&P is dropping. So there's a lot of distance again between the two before they actually converge. At this rate, it doesn't seem like they're going to converge anytime soon. We need to see a little more regularity and less uncertainty between this market. We've talked about this on this channel multiple times and even on TradingView. But typically they want to converge. So we are seeing a very strong divergence here, about 50% on the higher end, on the lower end. On the higher end, it's about 80%, so a huge divergence. I don't see it converging anytime soon, but we can see as long as they start moving together, it kind of indicates that things are starting to regulate slightly. But where does that leave us? Again, not investment advice, but we could identify bottoming outs based on dropping VIX, dropping bonds, dropping gold into some of this equity asset. But again, we really need to see what happens with a lot of this news, the coronavirus news and so forth. But for the time being, is this the bottom? Is it time to start buying? At this point, not really. We want to see what earnings do. We have a lot of time to wait. For people that are sitting on cash, you guys are in a very good position, and staying in cash until you see something that's very attractive is the go-to. Now, as I mentioned before, unfortunately, worst case scenario, S&P 500 might not be the S&P 500, but a lower number. And if that's the case, where should you invest? Well, again, not investment advice, but looking for strong companies is a very, very good way to start. Companies that have a lot of growth, a lot of value, a lot of potential, and will be there no matter what, and are very resilient, are companies that you want to go by. There's certain tech companies that are going to do good when this thing rallies. They're going to exponentially increase. There's biotech companies. There's a lot of companies out there that are really sturdy. A lot of them can be found on the S&P 500, the larger cap companies that withstand a lot of this. So just be very careful. The way I'm going to approach this is ETF based and look for ETFs that have sturdy holdings. Just be careful with a lot of bank stocks, as you can see interest rates are dropping exponentially, which does affect the bottom line of banks, mortgage lending, just general lending. So we could see a slight risk on notion from banks for quite some time. So let's just be careful with that. We don't want to see any more bailouts from the states. In terms of banks, we don't want to see any more failures. We want to see this thing recover as soon as possible. We're not here to praise the downside. We want to see everyone do well, pensions and everything. So if you guys enjoyed this very lengthy video, this is Victoria from TRADEPRO Academy. I hope you guys took a lot of information out of this and where you could be looking to find value in this market and where it could be bottoming out. So if you guys really like this, drop a like down below. Hit me with a comment. What do you guys want to see? What did you guys think? And ring that little bell to notify you when we do go live. Take care, everyone.